Good afternoon, everyone. I'm going to share with you this afternoon 5 topics that our global team think that we need to watch for global equities in 2025. The 5 things are not Trump, 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 and Trump, but very close. We're going to start with where the equity markets are at the moment, where the expectations are, and what consensus thinks for 2025, so that we've got a ground level to work from. Second, our new President Trump, who I don't expect to be quiet. Third, we're going to look at China and Europe, 2 regions that we think have quite a lot to grapple with this year. Fourthly, AI, what happens beyond the hyperscalers. And fifth, we're going to look at private capital, which is gaining share in markets and is looking perhaps to democratize access. So let's start with the markets. Here are normalized over 2 years. You can see the main indices around the world. The S&P 500 up 52%. The Nikkei's done well as well, off a low base. But the main reason for that is what we term the Magnificent Seven. So that's the top 7 tech companies in the world. And they've actually gone up 2.5 times over 2 years. The rest of the world, though, although it looks very flat down at the bottom, are up about 30%. So they've performed well over the last couple of years. Where evaluations, on the bottom part of the chart, you can see that the price-earnings ratio for the Magnificent Seven is about 31 times. And the rest spans between 19 times and for the S&P x the Magnificent Seven and 13 times in Europe. So they're fairly full valuations. This slide gives us the earnings, the actual earnings per quarter, and what the analysts thought they would be pre the announcements. And you'll see that since 2021, the only period which is surrounded by the red circle there is the third quarter of 24, where the actuals haven't beaten consensus. So there's a lot of expectation in the market to deliver. And also, if you look at the expectations going forward to 26, those numbers are quite punchy. These are the growth numbers here, and you're looking at high single digit and into the teens. So we feel that a whiff of disappointment may raise the risk premiums and tension in the market. So that's the first thing that we need to watch. Second, President Trump. There was a good panel yesterday, I don't know whether any of you saw it, on Trumponomics. And I tend to agree with their conclusions that the result is that Trump really wants to shock, but he also is prone to change his mind. But he does watch the markets, and so that may be one way that he can be curtailed. If we look at the policies that we've listed here on the slide, taxes and deregulation are pro-growth. And then the other camp is the inflationary policies, like tariffs and his immigration policy. The chart there is showing the reaction of the US dollar and treasuries, 10-year and 2-year, since he won the election in July. And you'll see they've reacted quite strongly, with the dollar, I think, up about 8%. I'd like to look a little bit more into tariffs. I mean, those first and his general policies, I think, are going to cause volatility in markets. We have seen that in the past with new presidents. We often see a lot of volatility as they sort of settle in over the first period. But with Trump, I think we're going to see that continuing because of this change in his view quite often. Looking at the tariffs, they're really big numbers he's banded around. I'm sure a lot of us feel that that's his opening gambit. But nevertheless, in his first term, the tariffs that he input, which is this line chart, he managed to increase the average import prices into the US by about 3%. The numbers he's talking about now, if they were implemented, would increase the average import prices by over 20%. That's really big numbers we haven't seen since 1935. So these are really big changes he's asking about. And you can see from the chart on the other side there that, no surprises, Canada, China, and Mexico are the largest trade partners affected by this. So from an equity point of view, we suggest that you really do look bottom up at companies, because a big American multinational, obviously based in the US, is bound to get its supply chain from all around the world. And so those parts and even the finished goods are going to have to be re-imported into the US in order for them to sell them. So they're going to get hit by those tariffs. In fact, there's some analysis I've seen that says that Canadian companies are going to be better off than the American ones if they impose this tariff, because of the direction of where the ultimate consumer is. So the second point there, volatility in markets and bottom-up analysis is important. On to our next topic, which is China and Europe. These two countries have quite big challenges. And the question is, will Trump's policies exaggerate these challenges, or will it spur them into action to try and mitigate them? In China, as I'm sure you all know, it's facing the point in time when the people who were born prior to the one-child policy are retiring. And so the labour market is shrinking very rapidly, and this is causing the chart there showing GDP growth expectations slowing quite considerably. It's the main driver there. They can't do much about the demographics, but they are trying to stimulate the economy, and they've got initiatives to try and grow innovation and tech, with high-tech related final demand expectations rising to about 20% of the market by the end of the decade. So the question is, can they do that? And along with the tariffs that might be imposed, which way is it going to go? In Europe, the picture is slightly different. Have we actually got to peak pessimism? We've got really soggy economic growth, if at all. We've got industrial contraction. We have a war in Ukraine, political turmoil, especially in France and Germany, and growth in nationalist movements. Importantly, though, this chart shows the change in productivity between Europe and the US, the gap there that has occurred since 2020, and this is the impact on GDP. It's about 18%, and it's going down even further. So what can Europe do to arrest that? Draghi wrote a report last year suggesting much more collaboration, and maybe the need for greater defense spending and R&D will get the Europeans to collaborate more. And obviously, with the overload of potential tariffs, Trump might stimulate more of that. So those are the question marks over those two areas. Moving on to AI, and we've talked about this a lot today. We still believe the hyperscalers will do very well, and indeed they're one of the main drivers of those quite punchy earnings consensus estimates. However, I think we'll be able to start looking beyond that to the semis, semi-equipment, and also to infrastructure, data centers, and the power that is needed to supply those data centers. We've been looking in our research, which I'll give you some links to at the end, sector by sector on how we think AI is going to affect them. This is a slide here from on the right-hand side from a B2B survey that we conducted in December. We asked the CTOs of 97 global banks lots of questions, but one of them was this, that where do they believe they're going to get the biggest productivity gains from AI? And top of the list there is risk management and fraud detection, as you can see, followed by enhanced data and analytics, and consumer services, the third. They also said that they expected to get productivity gains of about 5 to 10% over that period. Private capital is our last topic. This is an area that has grown very rapidly. As you can see from that top chart there, table, private equity is expected to grow, the assets under management are expected to grow 103% from to 2029 from a 2023 baseline. The dry powder, money that they've actually raised but they haven't invested, is in the order of 3 to 4 trillion. What is that going to do to markets? I mean, obviously, they will be looking more to privatize companies. But also they're looking to try and democratize it. Both State Street and Apollo have announced that they would like to launch private debt ETFs. Personally, I think that's going to come with a good overlay of regulation, given the risks involved. Anyway, it's on the market. On the next slide, you can see this is from public markets. On the left-hand side, that's the amount of companies that have been privatized. And on the right-hand side, it's the number of IPOs. So you can see they've just plummeted. So the public markets are really losing at the expense of private markets. Sorry, the other way around. Private markets are... I'll get it right. You know what I mean. Right, so that's the end of the 5 topics. This slide here, I'm just going to leave it up for a second so that you can perhaps scan the QR code. Those are the front pages of deep dive research, and by that we mean research that is in-depth analysis, 50 to 60 or more pages, collaborations across our team. Our team at BI consists of 475 investment professionals with an average experience of 15 years. We cover 2,000 companies across the world, and we have teams covering equities, corporate credit, fixed income, FX. We have teams strategy for all of that as well. We cover market structure and ESG. For everything BI, for those of you who have a terminal, please go to BI Go. So with that, I'll just give a quick summary of what I've said today, that we see markets are quite fully priced. There is a lot of growth to come. However, any disappointment increases the risk on the market. Secondly, Trump probably means some volatility, especially in the first year. The tariffs, inflationary, and on top of that, we feel that you need to look to a bottom-up analysis to be careful about the supply chains and the impact that has on margins. In China and Europe, what is going to be the outcome? Are these problems going to be exaggerated by Trump, or are they going to step up and improve stimulus or collaborate, depending on which region we're looking at there? AI, look beyond the hyperscalers, and private credit is very, very powerful. So with that, I would like to hand over to Mark Miller and say thank you very much for listening to me, and good afternoon.